Following a midweek trading halt, silver markets have experienced notable price volatility, with the metal dropping to $87 before finding support in the $87.20 to $89 range, a zone previously identified as resistance that has since transitioned into support. Price briefly recovered to $90 before declining sharply to $85 and is now trading around $86. The 150 exponential moving average, currently sitting at $85, has historically acted as a support level in this market, and analysts are monitoring it closely as a key confluence point for traders watching price action in real time. Adding a significant institutional dimension to this story, financial firm Jane Street added 20.6 million shares of the silver ETF known as SLV during the fourth quarter, making it the single largest holder of that instrument, with a position valued at approximately $1.3 billion. This development is drawing considerable attention from market observers, particularly given Jane Street's recent regulatory history. In July of 2025, India's Securities and Exchange Board temporarily barred the firm from Indian securities markets following allegations of generating unlawful gains estimated between $550 million and $567 million, tied to alleged manipulation across specific expiry days. That ban was later conditionally lifted after compliance proceedings, and the firm deposited the full alleged unlawful amount into an escrow account. The case remains ongoing, with appeals still pending. The firm is also reported to be under regulatory scrutiny in China, following the India probe. Turning now to the underlying market data that has been drawing attention from analysts tracking physical silver conditions. Silver backing futures on the Comex exchange has continued to decline, with registered silver inventory now standing at 86.3 million ounces. However, it is the movements in lease rates and swap rates that observers say materially change the picture currently being presented by spot price action alone. Under standard market conditions, one-month silver lease rates typically trade near 0%, sometimes slightly positive when lenders seek returns, and sometimes marginally negative when excess inventory exists in the market. Rates above 0.5% are generally considered a signal of stress. The average lease rate stood at positive 0.04% in 2023, moved to negative 0.18% in 2024, and has now reached positive 1.6%. That figure indicates that market participants are paying significantly more than normal to borrow physical silver, not for speculative purposes, but to meet delivery obligations that cannot be fulfilled through other means. Swap rates are telling a similarly striking story. Under normal circumstances, silver swap rates trade slightly above cash rates, as silver owners seek returns in exchange for temporarily exchanging their metal for cash. Currently, however, swap rates stand at deeply negative 2.8%. This means market participants are effectively paying to secure physical silver today, while agreeing to return it 1 year from now. Observers note that while this situation appears to present a straightforward arbitrage opportunity on paper, the fact that no significant volume of participants is executing that trade at scale suggests the market does not have confidence that physical silver will be easy to source 12 months from now. The concern, analysts say, is not one of capital availability, but of certainty of delivery. Wednesday's trading halt has generated additional scrutiny beyond its impact on price momentum. Volume data recorded during the halt period shows 31,828 contracts were traded while the metals market was suspended, an amount equivalent to 159 million ounces of silver that may have been cash settled. Market observers note that the appearance of volume data during a halt period is not consistent with standard technical disruptions, and instead points to off-exchange contract settlement activity. This is now the second major trading halt recorded within a 3-month window, with both instances occurring in close proximity to first notice days of major contract months. February gold contracts continue to show approximately 4,000 open contracts, representing 12 tons valued at approximately $2 billion, that remain unsettled beyond their expected window. Separately, the Shanghai Futures Exchange suspended 25 trading groups in February for position limit violations. The clustering of trading halts, delayed settlements, and exchange enforcement actions around delivery periods is being noted by analysts as a pattern rather than a series of isolated events. Turning now to the broader market signals that analysts say paint a more complete picture of the current situation. Data from India adds another layer of significance to this developing story. The Securities and Exchange Board of India has authorized $385 billion worth of actively managed equity funds to allocate up to 35% of their holdings into silver and gold instruments. That regulatory green light now opens the door for institutional capital to rotate into hard assets at significant scale, a development that market observers say carries considerable weight given India's already strong retail appetite for gold exchange-traded funds. Meanwhile, central banks globally continue to accumulate physical gold at what is being described as a record pace. When viewed alongside the trading halts, algorithm-driven price swings, and physical delivery pressures discussed earlier, this pattern of sovereign wealth fund and central bank accumulation is being noted by analysts tracking the divergence between paper markets and physical market conditions. Another data point drawing attention is the behavior of silver mining stocks relative to the underlying commodity itself. Silver has declined approximately 27% from its recent high of $120. However, silver mining equities have fallen only approximately 6.5% over the same period. That divergence, where mining stocks are significantly outperforming the underlying commodity during a correction, is being characterized by market observers as a notable structural signal. The argument being made is that the companies managing silver mining operations are demonstrating resilience that the spot price alone does not currently reflect. Additionally, observers note that price behavior at the $90 level is being described as more structurally sound than the prior spike to $120, not in terms of price level, but in terms of market character. The 150 exponential moving average support and the relative strength of mining equities are being cited as indicators that institutional money positioned in those companies may be responding to physical market structure signals rather than short-term paper price action. On the other side of the ledger, several factors are identified as potential delays to any resolution of the pressures described. Jane Street's sizable SLV position gives it the capacity to influence short-term price action through buying and selling cycles. The Shanghai premium could narrow if Chinese industrial demand were to soften. Additionally, commodities exchanges retain the ability to continue rolling contracts forward into future delivery months, as was the case when the March roll moved 71 million ounces forward, relieving immediate delivery pressure and pushing obligations into the May and July contract periods. As we bring together the various threads of this developing story, the picture that emerges from silver markets is one defined by a notable tension between paper-based price action and physical market conditions. On one side, lease rates have spiked to positive 1.6%, a level described as significantly elevated compared to the average of positive 0.04% recorded in 2023 and negative 0.18% in 2024. Swap rates have moved to deeply negative 2.8%, and open interest on the Comex exchange has fallen to what is being described as its lowest level on record. On the other side, trading halts, contract rollovers, and algorithm-driven price swings continue to shape short-term price behavior in Western paper markets. The contrast between Western spot prices and Eastern physical markets remains a central data point in this discussion. With Shanghai spot silver trading at $97, Shanghai futures at $100, and Western spot prices at $86, an $11 premium on physical silver in Eastern markets persists. That premium, which has held through multiple failed price breakouts and at least 2 trading halts in the past 3 months, is being characterized not as temporary arbitrage, but as a structural separation between paper pricing and physical availability. The volume data recorded during Wednesday's trading halt continues to attract scrutiny. 31,828 contracts were reported as traded during a period when the metals market was halted, representing the equivalent of 159 million ounces of silver. Observers note that visible volume during a halt period suggests off-exchange contract settlement activity rather than standard market operations. Adding historical context to current exchange behavior, it is worth noting that this marks the second major trading halt in 3 months, with both occurring in close proximity to first notice days of major contract months. February gold contracts continue to show approximately 4,000 contracts in open interest, representing 12 tons of gold valued at approximately $2 billion, that remain unsettled beyond their expected settlement window. The Shanghai Futures Exchange separately suspended 25 trading groups in February for position limit violations. Taken together, these events, trading halts, delayed settlements, and exchange enforcement actions, are all clustering around delivery periods. The data points observers say carry the most weight in assessing physical market conditions are lease rates, swap rates, the Shanghai premium, and the behavior of open interest, as opposed to short-term spot price movements attributed to algorithmic trading activity. The counter-pressures identified in this report, including the spike in lease rates, deeply negative swap rates, collapsing open interest, off-exchange settlement volume, and the resilience of silver mining equities, are all being cited as indicators that reflect conditions in the physical market rather than sentiment-driven paper trading. It is important to note that everything reported here is drawn directly from market data, regulatory filings, and exchange records. Viewers are encouraged to independently verify lease rate data, review Jane Street's current regulatory status, and consult Comex registered silver reports directly. This has been a data-driven review of current conditions across silver spot markets, futures markets, physical delivery indicators, and institutional positioning. We will continue to monitor developments as this story evolves. That is the full report for this segment. Thank you for watching.